All successful traders swear by trading rules, trading routines, and trading rituals. In this video, I take a look at 10 essential rules that all successful traders follow. If you are not following any of them, then make them part of your trading arsenal to move your trading to the next level. The number one trading rule is don't blow up your trading account. In that, if you blow up your trading account, then obviously all the other things you learn does not matter anymore because you can't trade, period. So blowing up of accounts is the accumulation of wrong decisions that traders make. And mind you, you can bleed to death from 1,000 paper cuts. So if you make small losses, eventually it accumulates and leads to blowing up of your account. And these wrong decisions can be psychological in nature. For instance, trading whilst tired, trading whilst you are not in optimal condition, revenge trading. These are some of the decisions that traders make that leads to blowing up of their accounts. Also, your level of technical knowledge is very essential. So if your level of technical knowledge is not enough, then obviously you may trade and make losses, which may eventually lead to blowing up of your account. For instance, if you trade without stop loss, if you have a static trading size and all those other issues, may end up blowing up of your account because the market is dynamic and you also have to be dynamic. To avoid blowing up of your account, stick to high probability trades. And know that in trading, there are not a lot of opportunities for you to make money. But being aware and having a process to control yourself helps you to end up having only trading trades with high probabilities. Another way to avoid blowing up of your account is to have a trading plan. If you have a trading plan that tells you which type of trade to trade and which types not to trade, then obviously you end up trading trades that works in your favor. Also, one way not to blow up your account is to review your trades. Every day after trading day, review your trades and know the decisions you are making right and the decisions you made wrong. And also trade small size. If you unfortunately blow your account, then I will recommend you take a break from trading. Paper trade and watch the market live and then analyze where you are having issues. It might be that you may never be able to find out the problems you have as a trader. That is when a mentor may come in, or you may have to take a course that teaches more about trading so that you can deepen your understanding and knowledge of the dynamics of the market. That way you can get onto the path of profitability. In trading, you can control your process, but you cannot control your outcome. So risk management and money management parameters should be very essential part of your trading so that you can control the amount of money you give away when you are trading. Otherwise, you end up blowing up of your account. So one thing I see with new traders is they are always interested in technical analysis, chart analysis, chart patterns and candlesticks, blah, blah, blah. But I think risk and money management should be very essential because without accounts, all the other things count for nothing. So always be aware, risk management and money management parameters should be very essential part of your trading methodology. And it's always good to have a default that when you are trading, expect the unexpected because the unexpected always happen. Why am I saying this? It can just take a speech by a politician, a bank official to make nonsense of all your technical analysis. So always expect the unexpected so that when you are trading, once again, Risk management and money management should be very essential because anything can happen in trading, and they do actually happen. Also, let the chart in front of you decide your next move when you are trading, not a preconceived notion of an analyst you heard from CNBC, because the market can do whatever it wants to do. So the earlier you accept it, the better. In trading, FOMO refers to missing out on trading opportunities, which some traders assume if they miss out on such obvious opportunities, then it's going to be difficult for them to grow their trading account. This have the effect of sowing an element of doubt about their ability as traders, and this can also lead to they doubting themselves, and obviously it doesn't normally end up well if you have such challenges. The way out is to understand that the market has been around for over 100 years and the market is not going anywhere. If you miss out on one opportunity today, there will be another one tomorrow. So don't freak out if you miss out on any opportunity. The way forward is for you to always have the desire to grow and get better as a trader, because the more you grow and get better as a trader, the more you can have opportunities to make money. And in that way, when you miss out on one opportunity, you will not be worried. And also, it's good idea you set specific goals, so that if you know that your goal is to have some targets by end of the month, if you miss out on one trading opportunity, looking at it from your goal for the month, then that one opportunity becomes so unimportant, so that you will not be worried about missing out. Also, it's good idea to have other things going on, so that when you miss out on an opportunity, you will not be too worried, because trading will not become all in all for you, because maybe you will be involved in other businesses or other things. That is the way most professionals do. Accept that the nature of trading makes it that you cannot totally eliminate emotion from your trading, because you are putting your money on the line, which obviously make you a bit apprehensive. But the way to go is to find a strategy or a system that helps you detect when you are getting emotional, so that you can try to minimize it as much as possible. One other way you can try to reduce your emotions when trading is to practice emotional detachment. There will be another video that will talk about step-by-step process that you can take to help yourself to reduce your emotions when you are trading. Also, one way for you not to get emotional is to see losses as part of trading. You have to see losses as cost of doing business, because all other businesses, before they become profitable, they incur costs, that is costs, expenses, before they become profitable. So as a trader, you also have to see your losses as expenses or cost of doing business, so that at the end of the day you won't be too much worried when you incur losses, because it's part of trading. And all successful traders accept losses as part of trading, and they make losses. Most of them win about 50-50, or sometimes they even win less. The only thing is they make sure that when they are winning, they make more money than what they give away. And also, never trade with financial targets, because if you have financial targets for each day or each month, it forces you to trade even if the market is not providing you opportunities. You only trade when the opportunity the market provides meets your criteria. Otherwise, stay neutral. Do nothing. Just conserve capital. In trading, there are 3 positions: buy, sell, or do nothing. That is neutral position. And all these processes are very essential. In trading, doing nothing is considered doing something, in that you are conserving capital for better opportunities ahead, rather than wasting them on substandard opportunities you have today. So develop a system to stop yourself from dabbling in substandard trades. And there's one thing you should know: Making money in trading is very difficult, and keeping it is even more difficult. Why is that so? Because if you make money and you don't control yourself, you end up dabbing in trades that does not give you edge, which will end up sucking your money away from you. So every time, remember, try to conserve the money you make. If the opportunities the market provide does not meet your criteria, stay away. Don't let emotions force you into trading. In trading, it's a bad idea to have a static position size. By this, I mean you should not have specific size that you trade all pairs or all assets. In that, for the same assets or for a pair, the volatility keeps changing based on the market conditions. So if you use static position size, you are in other words saying the opportunities or the volatility will always remain the same, which is never the case in trading. So the better option is to consider the volatility of the assets or the pairs you are trading, as well as the ideal place to place your stop loss, so that you tweak your position size based on the opportunity available to you or what the market expects you to do. And also, most people, when they are thinking about position sizing, always think about how much they can lose. But it's also good to think about the probability of the opportunities. If you have a setup with a lot of confluences all pointing in the same direction, then the probability of such a trade becoming successful is very high. So you may consider also increasing your position size a little more in order to take advantage of such a unicorn or such an opportunity. For you to have success as a trader, you have to identify the strategy that you trade very well and you constantly make money out of it. And once you identify assets that you trade very well or pairs that makes you money all the time, then the next obvious thing to do is to deconstruct it by breaking it down, knowing all the dynamics of that setup, so that you can know what you can do to make more money or most out of that setup. That way, you don't have to be in the market all the time, but you just have to wait for the strategies or opportunities that gives you an edge, so that you dabble in it or you become aggressive or kind of aggressive and make the most money. And then after that, you retreat and just wait for the next opportunity. Also, another way to develop an edge is to record your trades, know the time that you make most money. So for instance, if you make most money after London Open or during New York London Open, then make sure that during those times you are available to trade. That way you don't have to be glued to your computer the whole day, but just concentrate on the time you make most money and then trade during those times. And another way to develop an edge is to backtest. Come up with setups or strategies from others, or you yourself develop it, and then you backtest it. Backtest till you get a positive expectancy. When it's giving you edge or is showing that when you trade you make money out of it, then you can start trading it live with very small account size, and then gradually you increase it. Can make you more money than give away money. Your trading plan should include the process you take from formulating ideas till taking profit or taking a loss. Having a trading plan is very essential in that it helps you to stay away from trading low probability trades and concentrate only on trades that meet your criteria as laid out in your trading plan. There will be a video on trading plan, but generally your trading plan should include your goal, your long-term goal, your routines, assets you trade, the money management criteria, your time frame, sections you trade, your strategy, hypothesis, your psychology, and journaling. So if you have all these things laid out before you start trade, what happens is your trade will not be done randomly. You only have a criteria you want to see before you trade. And if those criteria are not met, you don't trade. So this helps you to move from random trades to more systematic or robotic trades, and that should be the goal, not to just trade anyhow, which may end up you blowing your account. The information in your journal should help you improve as a trader. You can only get better as a trader if you are able to correct the mistakes you make. And the way you can correct the mistakes you make is to analyze your trades so that you know where you do better and where you are performing not so good. So if you know where you are doing better, then you can deconstruct them and know how you can make more money out of them. And also, if you are able to see your weakness, then there are two things. Either you eliminate your weakness and concentrate on your strength, or your weakness, you try to minimize the damages they can cause to you by correcting them or not trading them with so much size as you trade the trades you have edge in. But all these things can be done if only you journal your trades and analyze them creatively in ways that takes advantage of your personal strength. There are lots of trading journals. You can use the traditional paper and pen to record your trades as you trade them, or you can use online journals, or you can use online journals, or you can just use Excel. You can use Evernote, Edgeworm is some of the most popular online journals. So you can just use Excel and develop it yourself and record your trades. But it's a must. All professional and successful traders record and journal their trades. So you should not be an exception. You should be recording and journaling your trade as well. Finally, the last rule most successful and professional traders swear by is that they do the work. Nobody is going to do it for you. You have to do it yourself. You get to YouTube, check out some of the best resources for trading available there for free and take advantage of them. Get a lot of books on trading that are very useful, that comes highly recommended. And also you can enroll in a course. Also you can get yourself a mentor and all that, and make sure that you can get the most out of these people who are willing to help you. And talking about a mentor, sometimes you don't even need to have contact with the mentor, assuming you cannot pay the cost, but you can follow all the things that they make available to the trading community so that you can read their books, you can listen to all the YouTube posts they make and everything, so that you have as much information that you can get from them. There are a lot of materials for free that can help you to improve as a trader if you are willing to commit to. Also, if you start and you are not making money, don't get frustrated. You just have to check your strategy. Maybe you have to think about paper trading for a while, and also always be watching the market and make sure that you understand the dynamics of the movements of the market, so that with time you can internalize it, and this eventually helps you to become a better trader. Also consider investing in your personal development, especially reading books on personal productivity, reading books on decision making and all that. These are very essential because if you're able to learn so much about decision making, when you are trading, you are basically making decisions. So if you are good in decision making, it will be easier for you to trade rather than just making decisions randomly without considering variables. So get better, improve yourself, and then it will be easier for you to be a successful trader. Finally, there is this bonus point. Trading can be very lonely and boring because you can sit 4 hours, 5 hours. If there's no edge, you don't have to do anything. So the way to avoid this is to make sure that you enjoy trading. And how do you enjoy trading? Make sure that you have other things going on so that trading does not become all in all to you. Because if trading becomes all in all to you and things don't go your way, then you get more frustrated. So maybe you can get yourself involved in other opportunities like investing or doing real estate or other things. And also, you also have to think about being the type of person who is there for others, like getting involved in charity causes and all that, so that your life will have a bigger meaning to you. And this can drive you more and makes you a better person than just getting yourself totally engaged in trading. That can get frustrating if things don't go as you expected. So now it's your turn. Which one rule do you consider absolutely essential for trading success? I really want to hear from you. Like, which rule, if I have to pick one rule to be very essential, which rule do you think it will be? Will it be like having a trading journal or a trading plan or your trading size? Tell me. I want to hear what you think. Also, is there any other topic you would like me to talk about? Let me know so that I'll also discuss it, because as trader we all share. I learn from a lot of other people. It's the same way I also want to share what I learn. Have you gained any value from this recording? Please consider subscribing, because it really helps for me to share more with the trading community. Please consider subscribing, smash the like button and share with your friends so that you become among the first to receive any new recordings I make. It really supports us. Thank you for your time.